Okay, so in this session that I'm going to explain what are the different methods of calculating stock, or we can say inventory. So I'll be explaining the methods of accounting for its inventory and how to calculate the gross profit and net profit and adjusting the inventory based upon the physical count. And also we will calculate the selling price, inventory turnover ratio, gross profit ratio, and markup on the inventory cost. Okay, so what are the different methods of accounting for its inventory? First of all, that I'm just going to explain you that how to calculate the closing stock or how to calculate the ending inventory. For example, the number of units on hand at the time when we have counted at the end of the period physically in the store. For example, that we have here 185 units, right? So ignore this dollar sign. So 185 is the unit and 25 units each. So 185 into 25, that will be 4,625 value of the stock that we have. So in this case that we will calculate physically, right? So unit cost, how to calculate the unit cost? Cost means the purchase price. At the time when we buy some articles, we get some discount. Discount will be deducted. Maybe some quantity discount is there also where we will deduct, we will minus it. And plus any cost necessary to put the unit in the saleable condition, such as freight in or custom duties or insurance, that will be added. So in this way that we will calculate the unit cost. What is the cost of the unit at the time of buying? Now we have some opening stock. We know that opening stock plus purchase during the period minus closing stock, that will be the cost of goods sold. Very simple. On the left hand side we see that 1 2 3 4 and 6, 4 plus 6, right? So beginning stock inventory, right, plus 6 more that we have purchased. So 10 unit that we have available for selling in the whole year. At the end of the period we find that the three of the units that we have in our stock. Take this example, these consider these are the laptops. So we have 3 laptop remaining in our store, in our showroom. So it means we have sold 7, so that will be the cost of goods sold. Now first method is the FIFO method, the first in first out calculation. And with the first in first out, the oldest one, the oldest means that we have purchased first, I mean the first in is matched against the revenue and assigned to the cost of goods sold. And we can say the most recent purchase are assigned to the unit at the ending inventory. So for Jones Nail, the name of the company, the FIFO calculation would be like this. Look at this. At the beginning, there was no any stock. During the year, we have purchased this one. So 100 pound LBS at the rate of 1.01, 80 with this rate and 90 with this rate. So the goods available for selling is 306. So once that we have, this is the value of this stock. Under the FIFO method, the first one is this one. So first, for example, that you are going to sell some of the article, 156 that you are going to sell, number of units. So in this case, what is happening? So 100 plus 50 is the 150. 150 pound of this article is going to sell. 100 from the first one, and like 50 more required from this 80 that we bought later. So 100 plus 50. 100 from this, the red one, and the green, that is the second purchase, second lot. From there, the 50 that will be collected from this lot. So total will be 150. So 150 and multiply with accordingly that at the time we bought it. This thing that we bought at 1.01 and the second lot that we bought the same article at 1.10. So now remaining inventory will be from this lot we have sold 50 and 30 that we have remaining. So this is first in first out, and the last one that will be the closing stock here. The last one, the 90 pounds that we have here. or 90 units, for example. So this is first in, first out. Second method is last in, first out. So last in, first out is just the reverse of the FIFO method, and the recently costs are assigned to the goods sold while the oldest costs remain in the inventory. That is the bookstore, for example. Look at this. Same example, but a different way. It's the LIFO method. Beginning stock, for example, is a 0. And net purchase, we have $306 that we have spent. First we bought this one, second we bought this one, and third we bought this one. As per the LIFO method, the last item that we have in the store should be sold first. So look at this, and the 90 will be sold here like this. And for example, during this period that we want to sell, or we have sold 150. So this is 90 from the last. Now it is finished. It is no more available. Now we have the previous one, means LIFO method, last in, first out. So the second last one, that will be 80, green color box. So we have this one, but we need to sell only 150. 90 we have sold, 60 that we will sell from here, and the 20 will be the remaining closing stock here. And the first one that we bought at the very beginning, that the totally will be considered as a closing stock here. So 20 plus 100, that will be closing stock here. Right? So this is the LIFO method. The third one is the weighted average method. The weighted average method relies on the average unit to calculate the cost of units sold and ending inventory. So what is the average cost? It is find out and determined by dividing the total cost of goods available for sale divided by number of units available for sale. Very simple. So in this case, that we have the 306. This is the price of the total all the units that we have purchased during the year, and we are going to divide by 270 pound here, right? So that will come to the average cost of per pound. So that will be 1.13333. So the ending inventory consists of 120 pounds or dollar 136, that is the 120 into 1.3333 average price per pound. So cost of goods sold was 170, so 150 into 1.333 average price per pound. So it is reflecting here. Look at this. So in this case, there is no FIFO, there is no LIFO. This is the average. So average that we have calculated on the basis of all these pounds, 100 plus 80 plus 90. So this is what? So this is 270. 306 is the cost, divide by 270. That it is reflecting here. 306 divided by 270. So the price that will be, average price will be 1.333. So during the period, the 12-month period, if you are going to sell any of the article or any number of units or any number of pounds here, so that will be reflecting with the same price all the time, because that average you have calculated. It is just like that the laptop you bought at the beginning, like $100 per laptop, later on 120, and again later on 150. So you will calculate the average. So that's why this is known as weighted average method of calculating inventory. Now, if we talk about the net profit, we know that net profit is like cost minus sale minus cost. So sale, whatever the sale that we have done during the period, minus cost of goods sold. So that will be the gross profit. If there is a gross profit that we calculated, sometime there is a loss on inventory. Inventory that we have in the store, some laptop, some mobile phone is broken. So that is the loss. So loss will be at the expenses of the company. So gross profit minus loss on inventory is equal to net profit. So sale is $50,000, cost of goods sold 48,000 plus this is the loss. Total cost will be 48,300. The gross profit will be 1,700. Now adjustment is very important. At the end of the period, you find that on our computer system it shows $170,000 worth of inventory, but actually when you find and calculate it in the store, you find that $165,000 costing of inventory is available. it means there is a shortage of $5,000 that will be considered as expenses of the company. So adjustment entry will be made like this. There is a loss of inventory account debit to inventory account. Or you can say cost of goods sold account debit to inventory. So cost has increased or loss on the inventory account, you can calculate either way. Now one ratio is very important to calculate the inventory system. This is known as inventory turnover ratio. It shows that how many times the inventory level of average level of inventory was sold during the year. High rate of inventory turnover mean high profit, means strong sale. Low ratio can point out to the weak sale and decreasing market demand for the goods. So what is the formula for this? The cost of goods sold divided by average inventory. Average inventory means inventory at the beginning, inventory at the end divided by 2 is the average inventory. So look at this one example. Walmart posted $75,000 in a cost of goods sold and $25,000 in an average inventory. To find out the inventory turnover ratio, we divide the 75,000 divided by 25,000. So that will be 3 times. It means the same inventory mean $25,000, 20,000 units. Inventory is circulated during the period 3 times. To calculate how many days it will take to sell the inventory on hand at the current rate, that will be 365 days in a year, we know that. So divide by 3, so it means 121.67 days, right? So it means how many days it will take to sell the inventory. It means 121 days they have taken to sell all the units, mean 25,000 units. Now, if we talk about the gross profit, we know sale minus cost of goods sold is equal to gross profit. And how to calculate the gross profit ratio? It's very simple. The gross profit ratio is calculated as the gross profit divided by the net sale. And it is the indicator of the company's profitability before deducting the operating expenses. So gross profit, let's say $2,000, and net sale is the 10,000 into 100 is the 20%. A gross profit must be large enough to cover the operating expenses and give the adequate profit. Second one is markup on inventory cost. What does that mean, markup? So markup is also a profit. So it is the profit on the cost. Previously that we have calculated the profit on the sale. So profit on the sale, this is the profit on the sale is the gross profit. Profit, this is also a profit, but profit on the cost is known as markup on the cost inventory or inventory cost. You work for the Best Buy, for example, in Canada as a sales director for the Dell product line. You have been asked to find out how much each laptop sale contributes to the gross profit. The selling price set by the Dell is $319. Assume that Dell Incorporation charges Best Buy $269. So $269 is the cost and selling price is $319 for each laptop they purchase. So what is the markup percentage on the product? So that will be sale minus cost divided by 269. This is the cost. So that will be 18.6%. That will be markup percentage. Now, if we want to know what is the selling price, if you know that your cost is 6,300, for example, and you know that you must achieve a gross margin of 10%, the required selling price can be calculated using this formula. So selling price is equal to cost divided by 1 minus a target margin percentage. Let's say selling price is here, the 6,300. How to calculate the selling price? 6,300 is what? 6,300 is the cost. Cost divided by 1 minus 0.10. So now this will be $7,000. That will be the selling price. So what we have learned, that we have learned the method of accounting for its inventory and difference between the gross profit and net profit. And also we have learned adjusting inventory based upon the physical count and inventory turnover ratio. We have learned gross profit ratio. We have learned markup on inventory cost we have calculated.